All right, let's take a look at the accounting equation. So the accounting equation is defined as assets equals liabilities plus owner's equity. So assets are items that the business owns that have future value. Liabilities are the business's debts. And owner's equity is the owner's share in the business. So let's take a look at if we were to expand the accounting equation out. So we have assets equals liabilities plus, we're going to break the owner's equity section out. So it'd be capital less withdrawals plus revenue minus expenses. So we have expanded out our owner's equity part of the accounting equation. So let's work on putting some transactions into this accounting equation. So the first transaction, let's think about an owner contributing cash to the business. Owner contributing cash to the business. Well, we know that cash is an asset. So assets, cash is going up. Owners contributing to the business, so that's going to make our capital under our owner's equity go up. So the asset side of the accounting equation goes up, and the owner's equity side of the accounting equation goes up by the same amount, so our accounting equation is still intact. So our accounting equation is our golden rule of accounting. Every transaction in accounting, the accounting equation has to hold. So assets have to always equal liabilities plus owner's equity. So if we were to plug anything in here and it causes assets to not equal liabilities plus owner's equity, it's definitely wrong. So let's look at another transaction. So we're going to purchase supplies for cash. So supplies are something that the company owns that provides future value. So supplies are an asset. So our asset supplies will go up. Let's say we purchase these supplies for cash. Cash is an asset. So the cash asset goes down. So our one asset goes up and another asset goes down by the same amount. Our accounting equation still works. Let's look at another transaction. So we say we perform some services for cash. So performing services, that's revenue. So our service revenue goes up, and we perform these services for cash. So our asset called cash goes up. The asset side of the accounting equation goes up. The owner's equity of the side of the accounting equation goes up. The accounting equation still works. So let's look at another transaction. Let's say we purchase some equipment on account. So equipment sounds like an asset. It's something the company owns that provides future value. Equipment comes in the door. Equipment's going to go up. We purchased this equipment on account. So on account triggers a liability called accounts payable. So the asset side of our accounting equation goes up. The liability side of our accounting equation goes up as well. Our accounting equation still works. So let's look at an example where an owner withdrawal. So an owner is withdrawing money from the company. So money being cash, cash is an asset. The cash is leaving the company, so that triggers cash going down. We know withdrawals reduce owner's equity. So we would have our withdrawal, which would reduce owner's equity. Cash goes down on the left side of the accounting equation. Withdrawals make owner's equity go down on the right side of the accounting equation. Everything works out. So two sides to every transaction. All right, everybody, please take a look and please let me know if you have any questions.